Welcome to Argunas Learn. Today, let's talk about risk profiling. This is the absolutely essential bridge that connects an investor's psychology to their actual investment plan. Getting this right is so important. It protects your clients from making bad choices, and honestly, it protects you, the distributor, from some major compliance issues down the road. Let's get into it.
At the end of the day, risk profiling is all about one simple idea: matching the right investments with the right person. It's got nothing to do with chasing the hottest new fund. It's about building a portfolio that actually lets the investor sleep peacefully at night.
So here's our game plan for this explainer. We're going to cover why profiling is so critical, break down its three core pillars, see how to balance them in the real world, and then we'll zoom in on exactly what you need to know for your NISM exam before we wrap up with a quick summary. So let's start with the big why.
So why do we do this? Why is this one of the very first things a financial distributor does? Well, you can think of risk profiling like a financial health checkup. It's that diagnostic step you have to take before you can even think about prescribing any investment product.
Look, the number one goal here is to protect the investor. This whole process exists to prevent a scenario where high-risk products are sold to people who just can't handle that level of risk. It's not about finding the biggest returns. It's more like a financial seatbelt.
And that brings us to the key term for this section. Risk profiling is, at its heart, a suitability check. Remember that word, suitability. It's going to pop up over and over again, especially when you're sitting for your NISM exam.
Okay, so how do we actually figure out an investor's risk profile? It's not just a single question, right? The whole process actually rests on three very distinct pillars. And here they are: the need, the ability, and the willingness to take on risk. As a distributor, you have to look at all three of these, and understanding the difference between them is absolutely non-negotiable. Not just for your career, but for the exam too.
First up, let's talk about the need. This one comes directly from the investor's financial goals. For example, if someone's goal is building a retirement corpus over, say, 30 years, they need the kind of higher returns that come from riskier assets like equity. But if they're just saving up for a down payment on a car they want to buy next year, their need for risk is practically zero.
So it's that simple. Just remember, need is always driven by a specific financial goal.
Next, we have ability. Now this one is purely objective. It's all about the numbers. Can they actually afford to take a risk? We're looking at things like their income, any loans they have, whether they have an emergency fund. But the single most important factor here is their time horizon. The longer someone has to invest, the more time they have to recover from any market dips, and that dramatically increases their ability to take on risk.
So, a simple way to think about ability is as a formula. It's their financial strength plus their investment time horizon.
And the final pillar is willingness. This is all about psychology. It links right back to our previous discussion on behavioral biases. An investor might have both the need and the ability to take on risk, but the real question is, are they going to panic and sell everything the moment the market drops 20%? That emotional strength, that's their willingness.
So willingness is really just their emotional capacity to stomach the ups and downs of the market.
So what happens when these three pillars don't align perfectly? Well, this is where a great distributor really proves their worth. Because in the real world, these pillars are almost always in conflict with each other.
Just think about a couple of classic scenarios. First, you might have an investor with really ambitious goals and a stable, high income, but they're absolutely terrified of the stock market. That's a case of high need and high ability, but very low willingness. Or you could have a wealthy client who has a very high ability to take risks, but their only goal is capital protection. So they have a really low need and low willingness.
So how do you solve these conflicts? Okay, here is the golden rule, and I want you to remember this one. You always default to the most conservative of the three pillars. If an investor's willingness is the lowest factor, then that dictates the entire investment strategy. Their high need and ability become irrelevant if the client is just going to panic and sell at the worst time. This rule ensures the investor is always protected.
Okay, so let's see how all this theory actually gets put into practice. How is risk profiling really done?
Well, typically, it's done using a structured questionnaire. This will ask questions about their goals, their financial situation, and how they might react to different market scenarios. Now, the tool itself can vary, but the one thing that is completely non-negotiable is that the process has to be systematic, logical, and well-documented for every single client.
This table illustrates the outcome perfectly. On one hand, you have a young, salaried investor, maybe 28 years old. They usually have a high need, high ability, and high willingness, which results in an aggressive, equity-heavy profile.
Now contrast that with an investor who's nearing retirement at 65. Their need, ability, and willingness are all typically low, leading to a conservative, debt-heavy profile. See? The exact same process leads to two totally different but perfectly suitable outcomes.
And that just brings us right back to our core principle. The goal of this whole exercise isn't to chase the highest possible returns. It's to find the most suitable path for that specific investor.
All right, now for everyone here who is preparing for the NISM VA exam, listen up, because this section is for you. You should absolutely expect to see scenario-based questions that are designed to test your ability to tell the difference between these three pillars.
So let's talk about two common traps to avoid. First, do not mix up ability with willingness. Just because someone is wealthy, that means they have a high ability to take risk. It tells you absolutely nothing about their willingness. Second, always read the question carefully to identify the time horizon for the specific goal mentioned. That's what's going to drive the need and the ability.
And here's an exam tip from us at Argunas Learn. If you're ever in doubt in a question, always choose the more conservative option. The exam is designed to test your understanding that a distributor's primary duty is to protect the client's capital, not to maximize their returns at any cost.
Okay, we've covered a lot of ground. Let's do a quick recap of the key takeaways from this module.
Here are the key points to remember. First, risk profiling is all about protection and suitability. Second, it stands on three pillars: need, ability, and willingness. Third, the final risk profile is always decided by the lowest of those three pillars. And finally, suitability always comes before chasing returns.
So understanding and risk profiling is really just the first half of the puzzle. Now that we know how to figure out an investor's profile, the next question is, what do we do with that information? Well, in our next explainer here on Argunas Learn, we're going to dive into asset allocation and see exactly how we translate a risk profile into a real, tangible investment portfolio. If you found this explainer helpful for your studies, please do take a moment to hit the like button, subscribe to Argunas Learn, and ring that notification bell so you don't miss our next module on asset allocation.
And a quick disclaimer, this video is for educational purposes only. It is not affiliated with, endorsed by, or sponsored by NISM, VA, or CB. Mutual fund investments are subject to market risks, so please make sure to read all scheme-related documents carefully before investing.